here to talk about is Fund 3. And I'll just, for those of you who may not be familiar with how a closed-end capital fund works, you commit to the fund, which means that you pledge a certain dollar amount, but we don't take that money right away. You're hiring us to build you a portfolio of real estate, and that takes time. And the way it works is that everybody becomes a pro rata owner in the fund. So for example, if we have 100 people all put $1 million in to the fund, we'd have a $100 million fund, and everybody would be a pro rata owner of 1%. If we go out and find a deal that costs $10 million, then we call 1% or $100,000 from everybody, and they have a 1% ownership in that particular deal. And so as we find opportunities out there and we are able to close on them, we call that capital from our investors, and we build that portfolio. And that portfolio construction will take about 12 to 24 months, we estimate. Distributions are also sent back same way, pro rata, based on how much you've committed. So as we sell assets, as we refinance assets, and as cash flow is created from the assets, that is sent back to investors based on pro rata. Now, the advantage of being an equity investor in a fund, there are tax advantages. Equity, you get shield depreciation, and then long-term capital gains. So generally, if you're in the highest income bracket, your overall tax rate is going to be about 25% because your income is going to be shielded. Now, our investments are IRA eligible. You can invest through your IRA, and we can talk through that if necessary, kind of offline. My partner and I are committing $10 million to the fund, and the minimum investment in this fund is $100,000. Keep in mind that your capital will be spread across 15 investments, so at a minimum $100,000, you will have about $7,000 to $8,000 of exposure per investment. Our average investment today is about $500,000 in the fund. There is a fee break at that level that I'll talk about a little bit, but we have investors at $100,000. We have investors at $10 million in our fund besides us. So let me jump. The waterfall, the way it works in our fund structure is that an investor receives a 9% preferred return, and you can think about that as an interest rate, but it's not guaranteed. When we sell, refinance, or send back cash flow, before we participate in any profits, we have to pay off the entire capital account. And the capital account includes that 9% preferred return, and then we have to send back all invested capital, and then only then do we participate on the back end of the project. The easiest way to think about this is we get 20% of profits so long as we do our job. If we only return a 9% annualized IRR to investors, then we make nothing on the back end. The front end fees, we charge a 3% upfront fee to investors. We have a 1.5% annual fee on invested equity, and then 20% of profits above that with a catch-up, and there's some nuances about that. But again, for accounts above $500,000, there is a fee break on that front-end fee. It's only 1.5%. And I do, fund structures a lot of times are compared to individual deals, and there's a lot of terminology that really has to be equalized to one another in this business, and where we don't take any other fees. We don't take acquisition fees, we don't take disposition fees, refinance fees, no fees. The fees that I'm talking about are all that we charge. In a deal-by-deal structure, if somebody has an acquisition fee, and we've talked to many of our investors about this, of 1.5%, 1.5% on an acquisition fee is not on equity. It is on the entire deal size. So if an asset is capitalized at a 2-to-1 debt to equity ratio, that becomes a 4.5% fee on equity. And even if a 1% acquisition fee is still a 3% fee. So we really have to, when we're talking about fees, we have to equalize them across funds and individual deals. So we are definitely at the low end of the fee structure. We are not a low-cost provider by any means. We have a very high-quality team who we've attracted and who we need to pay to execute our strategy. So lastly, before I hand it over to Tom here, we've acquired 4 assets, and investors coming in at the November 7th closing about 30% of your capital will be called right away, and it will go to work into those deals. The other 70% we anticipate will be called over the next 18 months. And so investors who are coming in through the fund have to prepare for that capital call as well.